Well, there they are again, those confusing accounting terms. You just can't get away from them. And it doesn't really matter if you're a startup business or part of a larger firm. At some point, you're going to have to measure what you're doing and report that information to people outside your company. And if you think about it, the demand for this kind of information can come from all sorts of places. It can come from a banker who needs the information before loaning you money, or it may come from your investors who want to know if their investment is paying off. Actually, demand for financial information could come from all sorts of folks, including your customers, suppliers, regulators, even your neighbors in your community. Let's face it, there are all sorts of stakeholders who want to know something about your business. So let's start figuring out what all those terms really mean and take some of the mystery out of this whole process. We'll start this week with a short video that lays out the different groups that get involved with financial reporting. And of course, it's an alphabet soup of acronyms: SEC, FASB, GAAP, IFRS. Seems like we have to convert everything into a set of initials. But no worries, I'll help you zero in on the important ones you really need to know about and show you how they influence the financial reports. Next, I'll introduce the three primary financial statements that will become near and dear to your hearts during this course: the balance sheet, income statement, and the statement of cash flows. Unfortunately, we have this problem of multiple names for some of these statements. For example, the balance sheet is sometimes called the statement of position or the statement of financial position. And the income statement is often called a statement of earnings or a P&L, profit and loss statement. What can I say? All I can do is apologize on behalf of the profession for this confusion, but don't worry, it's not going to slow us down. That kind of thing will only be a minor distraction, and we'll get past it in no time. After this, we'll start to drill down a bit on each of the three statements. First, looking in more detail at the balance sheet. This is the main financial statement from which all the other statements flow, so it's important to figure this one out first. Our analysis of the balance sheet will then naturally lead to a discussion about how individual transactions get recorded in the balance sheet, what I call keeping score. As a manager or entrepreneur, your focus is usually on running your business and doing what you need to do every day to try to make your company successful. It's the accountant's job to capture those transactions and record them in such a way that they can be nicely summarized in your balance sheet. So we will spend some time on that and show you how to analyze transactions and record them so they can be easily presented in one of the financial statements. And don't worry, I'm not talking about debits and credits. We are going to use a much simpler process that makes use of the spreadsheet format for recording transactions. And of course, sprinkled throughout will be an assortment of other activities to keep you engaged. These will include calls to action, where I may ask you to download information from a company's annual report, discussion activities, and short assessments that will give you the chance to apply, discuss, and test your understanding and make sure you're getting what you need out of the course. So what do you say? Let's get started.